things that I think are going to be exciting is around the collateral management space, for reasons similar to what we discussed around why pre-funding is not great. Finding a combination of interest-bearing assets and concepts of off-exchange that may or may not leverage custodians, those solutions are going to be really important. So that's more efficient use of collateral. This may sound boring, but for the institutional traders, they know how important this is and how efficient or inefficient the market could be. I think you're going to start to see some really good solutions that think about different type of tech in this space that allow for much more advanced collateral management without giving up on the level of credit exposure.
Hello and welcome to another episode of RULEMATCH Spot On, the only podcast focused exclusively on the institutional crypto and digital assets industry. I'm your host, Ian Simpson, and if you want to know what banks, securities firms, hedge funds, and others are doing in the institutional crypto space, this is the place for you. My guest today is Adam Levine, Senior Vice President of Corporate Development at Fireblocks. Adam spent many years in the financial industry, including 7+ years at CLS, where he was in product management and product development with a focus on post-trade settlement. Adam, welcome to RULEMATCH Spot On.
Thanks for having me. I'm really excited for today.
So, of course, Fireblocks is a company that really doesn't need any big introduction, but it is one of the leading companies around the world for crypto custody technology based on multi-party computation tech, and founded, if I understand right, in 2018. And now here we are in 2024, a few years later. And just to start off with, I'd be interested to understand from your perspective and from Fireblocks' perspective, how you see your role in this kind of evolving crypto space. Are you still just a tech provider for crypto custody, handling crypto assets, more of a transfer network, facilitating liquidity, or maybe something else? What is kind of the thinking right now at Fireblocks?
Yeah, Ian, thanks for having me on the podcast, and it's a great place to start. The mission at Fireblocks is really to bring digital assets to businesses everywhere, and we're doing that from the lens of technology. So while the core of Fireblocks does, as you correctly point out, start with cybersecurity and multi-party computation with our wallets, we are much broader than thinking of custody technology. So Fireblocks provides a variety of different types of wallets, but what helps differentiate it, in addition to the robust and security of those wallets, is the Fireblocks network and the services that we built on top of that. To be specific, thinking about tokenization capabilities, thinking about payments orchestration, and so much more. So ultimately, we want to be that technology layer that helps underpin what businesses are trying to do when it comes to engaging with digital assets. And those could be traditional banks all the way to fintechs and startups and gaming companies. They all are going to care about similar attributes of safety, security, resilience, speed, and the components you need to bring assets on chain. And that's where Fireblocks really sings.
Okay. And so that as you say, encompasses a lot of things. One thing that we notice, and we've talked about with podcast guests, is kind of the liquidity in the market, since that's where we come from as a trading venue. And it's very similar to FX, very fragmented, global, and so on. And of course, Fireblocks facilitates that. How do you see yourself sitting in the tech layer of the global infrastructure for crypto assets and markets for crypto assets?
Yeah, you correctly point out there's a lot of fragmentation, and I think as more and more players come into the market, we'll continue to see that. One could argue that's actually a really good thing for the evolution of both cryptocurrencies, but also just the broader sense of digital assets. For Fireblocks, we, again, want to be that technology provider that could provide a lot of the interoperability and connectivity that players need. So what does that mean, right? It sounds like sort of nice business cliche speak, but give you a few examples. There's dozens of protocols and thousands of assets that are out there in the market. And this year alone, we've seen so many new L1s and L2s come out. Fireblocks plays a very important role by being able to support those protocols, which then allows our 2,000 plus direct clients to engage with digital assets on those rails or those new standards. But there's a lot more. We think that some of the technology that we can provide can help mitigate risks for institutions that are trading digital assets. And that's going to be really important. When you have this fragmented liquidity and different market infrastructures jumping into the space, or those trying to figure out how, they're going to be thinking about the risk mitigation as much as they're thinking about the revenue and dollar signs, right? And so there's a lot that we can help underpin to help institutions as they're actively trading those assets.
Mm-hmm. So you mentioned institutions, and of course that's really the focus also of the podcast. You mentioned also that you really are a tech layer for everyone, but let's drill down on the institutions. We know that really the largest trading firms in the world are in the space. They're doing things in the space, but they come at it from a little bit different perspective than you or me trading for ourselves, of course, and doing things like that. What kind of extra on top things are you seeing or hearing from institutions that they want from your technology, but more broadly from the tech and the infrastructure in crypto markets?
Sure. So first, it obviously starts with the business case, right? In most cases, there's a revenue opportunity. They're looking at ways to engage with new clients, have new assets, or be able to conduct the business they have been doing, but do it a bit faster, cheaper, and with less risk, which ultimately is going to drive more profit. So you have the front office or business people that have that vision of how they're going to drive more revenue, how they're going to delight their clients better. But then when you think about the larger institutions, the payment service providers, traditional banks, you think about that second layer of defense. And I think of it as the B watchers and the B watchers, those that are actively looking at all the ways things could go wrong, right? That's what their stakeholders and regulators demand. And so there's a few different areas that they start to think about, and this is where we really focus, and all come around different security and risk. So first, thinking about the security, we find institutions as they dig into the different types of wallet solutions, multi-party computation or MPC very clearly is the standard as compared to a multi-signing, multi-sig approach. And so when we go through that process, it's one area where Fireblocks continues to invest because of how important that security is. We then think about things like insurance, and not only making sure we have insurance, but educating our clients on the different types of insurance. So often we speak to sophisticated institutions that say, oh, I just need insurance. Like, what do you have? And we are not an insurance provider, but we've spent a lot of time working with the market so that we understand what our clients need to consider about whether it's specie insurance or cyber and crime insurance. We know the type of insurance brokers out there that really know the space and know Fireblocks. And we've even worked with some providers and underwriters that are designing policies specific for our clients. So they can get unique policies that don't exist for others, or sometimes more cost effective, because those underwriters really understand Fireblocks. Beyond that, there's things around compliance controls and the level of security and the security standards we have, and even helping get consortia of security standards in the crypto market. We've taken a leading role in that. And those are some of the risks and concerns custodians are thinking about, and institutions more broadly think about as they look to get into this space.
Mm-hmm. Yeah, of course, banks are very precise and very, very focused on operations and very process oriented. And I'm sure that's where the tech has to line up with that. I mean, their attitude toward custody and more broadly from financial institutions comes from a totally different area than the retail client or even the small trading firm. There's a lot more that goes into it. When we just talk about banks, so of course Fireblocks is active globally. Do you see any difference in attitudes towards crypto custody or crypto custody technology and custody in general between, say, the US and European banks versus US banks?
We absolutely do. And there's a crypto story, and then there's the broader tokenized assets. And for both, we're seeing differences. I would argue that the differences in crypto are probably more severe than what we're seeing in tokenized assets. But suffice to say, we do see that, broadly speaking, European banks are most progressive, most aggressive, furthest along. There's certain markets where, outside of Europe, but looking at the UAE, Brazil are good examples where really sophisticated, established traditional banks are moving into the space in a meaningful way. In Asia, they're maybe in some cases further ahead and some a bit further behind. In Australia, now taking a very conservative approach. And then the American banks are probably the least advanced, with exceptions, for some obvious reasons. And it all comes down to regulation and the view of the regulators in government. So to get more specific, you see the European regulators come out with MiCA and DORA and give clarity to banks. And even when you have a bank with an agitator, a visionary that sees how digital assets and crypto can be a new opportunity for them, when there's uncertainty from the regulator, it's probably one of the biggest concerns a board or an executive team will be thinking about. And so in Europe, you see these examples where, because there's a bit more clarity, you have institutions like BBVA or SocGen that are coming into the space, both in crypto and tokenized assets. Other good examples, you look at LBW as the largest state bank in Germany, or one of our clients, Zürcher Kantonal Bank, a Swiss canton bank, taking some meaningful steps. That's really important. Now, you contrast that with the US, where it's a not so hidden secret, the view of the US government being so against crypto and for many, let's say, own goals that the industry has had. But the Americans have taken a much, let's say, you could argue between prudent or slower approach. I think the lack of regulatory clarity, one could argue, is with intention, again, because executives and boards have so much concern. But it's only recently, with the news with BNY Mellon coming out, where they were able to get an exception from SAB 121, one of many hindrances that banks have had. And it's just clear that while they're the first, I could rattle off one there where I'm able to mention much more in Europe that are taking meaningful steps in the space.
Mm-hmm. And that's interesting. Also, you bring up, the regulatory side of things. Is that also, do you think, the reason that in some areas where institutions are involved and custody is a topic, in the US, it seems like they often kind of outsource it to a provider, to a Coinbase custody, a BitGo, or so on. Whereas in Europe, you do have banks and institutions actually building their own custody solutions or looking for an independent provider.
Yeah, Ian, it's a little bit of chicken and egg, right? You could take the view there's established crypto native custodians in the US, and therefore the American banks are happy to sublicense or subcustody them or just let them in the space. But I think those in industry see that the irony of the US regulatory approach was the systemically important and heavily regulated institutions were strongly discouraged from getting in the space, which created an opportunity for these crypto native and in most cases private organizations to step up and play a foundational role in custody. So I don't think it was an intent for American banks ever to seek to leverage a sub-custody model with these smaller ones. But it has allowed for tremendous growth in institutions like Coinbase, BitGo, Paxos, Anchorage, and now Fireblocks with their trust company that we've launched. It's a big opportunity, and I think Coinbase is a great example of a public institution that's really stepped up on behalf of the industry to provide this role. But I think that the better answers will start to see that more and more of these American institutions are going to be jumping into the space, and that's going to bring competition. Now, the only other thing I would say is it's important not to paint the picture that in Europe it's only traditional players jumping in. Mm-hmm. There's a variety of very strong licensed custodians throughout EMEA, examples of Zodia and Komainu, DLT Finance, even Borsa Stuttgart has a different crypto arm that are also stepping up into the space. I just think in Europe, you're starting to see a bigger opportunity for the industry to compete between the traditional players and those crypto native that had that vision early on, where in the US, it's mostly a story of those crypto native custodians.
Still pretty segmented or segregated on that side of things. You missed one institution here in Switzerland. I'm thinking of SDX, who also, I believe, has built their Web3 custody solution on Fireblocks.
And it's a great example, and I'll get flogged by them later, but a very important client and playing a key role within Switzerland and Europe.
Yeah, of course. Well, I don't want to put you in a hot spot.
It might be too late.
Well, okay, sorry. Speaking of custody and banks, and then there's this thing we talk about sometimes, people who aren't banks but play like banks. And I'm thinking now, unfortunately, of some players in the crypto market. FTX is the name that comes to mind, unfortunately, who, combined many different functions: trading, market making, custody, at least for retail clients all together. And that obviously didn't end well. I know for Fireblocks as a tech provider, that's not really your game, but are you hearing people in the market talk about separation of duties or kind of really specialization also for regulatory reasons or other reasons?
Yeah, look, I'd love to say that the industry has completely learned their lesson, but you can look at non-crypto finance and see how people make the same mistakes. With that said, the better answer to your question is yes, right? Institutions are not, by and large, going to use an exchange for custody and do all their trading there and collateral management, similar to those in traditional finance. And you see a lot more sophisticated individuals from a TradFi background now jumping into digital assets, and they know the risks. It's the same risks that they were in traditional finance, but a different type of asset. And so we're going to start to see less of that completely vertical integrated offering. There's some degree of vertical integration that you could argue is appropriate, and you see it in traditional finance as well. But whether it's self-custody or custody, keeping that separate from your trading venue is going to be important. And also how you handle and manage your collateral is going to be the next extension. And I think that's where a lot of people got in trouble and blurred the lines between posting collateral and a custodian. Very, very big differences. But when you leave all your funds in one place where you're also trading, you're just very clearly exposing yourself to risks. The more sophisticated players are not going to be making that mistake, I don't think.
Mm-hmm. We see also some kind of sophisticated setups that are being made to deal with that, some off-exchange custody solutions with popular exchanges. We use the term a bit loosely there, but those setups have some advantages, and yet they are a little bit complicated. How do you think it's going to evolve as maybe some venues have a lot of liquidity, but not really the setup to serve financial institutions? Is there going to have to be a lot of consolidation or some of these kind of pieced together solutions to provide the security that financial institutions are looking for?
One of the reasons why I got involved in digital assets was less about the crypto story, but seeing how when you move traditional assets on chain, you can solve traditional risks with technology solutions that are not available in the same way when you use traditional tech. And versions of off exchange is exactly a great example. So it could be a bit specific. There's some institutions out there that they're part of a trading venue, and then they say you need to use their custodian. Or they have some solution where you're transferring the credit risk from the trading party to a service provider. And those provide some risk mitigation, but definitely some risk concentration. So at Fireblocks, we're really taking a more unique approach to mitigating those risks that doesn't necessitate shifting the risk to a third party and having that concentration risk. So we think about using our collateralized vault accounts with our off exchange as a combination of a legal framework and a technology solution to mitigate the risks so that you don't have to post all of your funds with the trading venue, but also the trading venue has a mechanism where, based on the rules of the legal agreement, they're able to access the collateral. And that's something that's unique, right? We're able to do that because of the way our multi-party computation system works and how we've thought about something that is sufficiently flexible from a tech perspective and can align with the requirements of both the trading parties and the crypto exchanges. And so we've been rolling that out over the last year with a few design partner crypto exchanges. And that's an area that we're really starting to see significant demand and pickup. And I expect there'll be different iterations of that where it's purely a technology solution where you have an account where, based on the rules, either the trading party or the venue can access the collateral. And some that may want that same thing through a custodian of their choice, not the custodian that's owned by that same trading venue.
Mm-hmm. Because again, that's not really a separation of duties in one sense.
Exactly. Yeah. And so I think this is, as you see adoption of that, it's going to unlock a lot more opportunity. Those that understand the risks are going to be really excited about not transferring the risk and concentration of credit exposure, but relying on the technology and still allowing the facilitation of trading appropriately.
And is that solution that you're talking about, that setup that you're talking about, something that's geared towards one jurisdiction versus another? Because there are, of course, legal considerations built into that, right?
Yeah, so no, it's not limited to a certain jurisdiction. We provide the technology and we can help guide on aspects of the legal agreement, but it does effectively become a tri-party agreement. And so the exchanges that we work with as design partners need to come up with the framework that works for them and their jurisdiction. And obviously the clients need to assess it as well. But we've been rolling it out in a few different jurisdictions. We expect this to be something you see globally. With each exchange having their own nuance and understanding their local law, but it should not be thought of as just appropriate for APAC or just in Europe. It's something we're seeing a lot of excitement in.
Okay, and can I ask where that has started already? Which jurisdictions?
Yeah, Deriva was our design partner, and we've been expanding it from there. And so I definitely think that you'll be seeing it throughout aspects of APAC and Europe to start. The US, for reasons mentioned before, is just a bit further behind.
Mm-hmm. So shifting gears just a little bit, you have a history in the financial industry at CLS. You were in product management and various roles there with a concentration on post-trade settlement. And I would love to pick your brain just a little bit about that in crypto, since traditionally, I use that in quotations, there hasn't been post-trade settlement, everything pre-funded. And that's partly where some of the problems came from, maybe in the past with FTX and others. People had things locked on the exchange. Now we're getting some different solutions coming to market, but very diverse. Some bilateral, some multilateral, some still very pre-funded. Where do you think, or how are you thinking about this in relation to TradFi, the development of settlement in crypto markets?
Yeah, the settlement issue is critical. For many, it's a sort of story that could put a coke addict to sleep. It's not the most sexy of topics, but as you dig into it, you realize that it's foundational. And you've seen, as you mentioned, FTX, a great example of when you don't pay attention to it, what could happen and blow up. And the same thing happens in traditional finance. That, in many reasons, is why there are financial market infrastructures like clearinghouses or settlement banks, like my former employer, CLS. It's a response from the industry that they know there's a problem. So settlement's foundational. And I mentioned earlier, I get excited about digital assets because it doesn't necessarily change the risks, but it could change the risk mitigation. And so we're going to continue to see the industry shift away from pre-funding. Pre-funding is awful if you're the one that's trying to do the trading, right? You don't want to use your collateral that way. You want to use it in the most efficient way possible. And when you do post collateral, you want to know it's done in a way that you deem to be safe. And again, why we think our off exchange is going to be really exciting for the industry. But the bilateral approach is something that I do think we'll see. Starting to have conversations now with institutions about how you can not just do bilateral settlement, but thinking about versions of netting to get that extra liquidity efficiency. I think multilateral solutions in digital assets is further away, if I'm honest, but definitely where the puck is going. And in the future, 5-10 years from now, it's going to be difficult to find any financial market infrastructure that's not using a blockchain-based solution. And so they're going to be, in many cases, powered by blockchain if they catch on quick enough. In other cases, I think you'll see that because of how the blockchain solutions are being developed, reduces the need for some of those financial market infrastructures. And I'll give an example of when you settle something on a delivery versus payment or payment versus payment basis, you mitigate that risk of settlement risk of you send the funds to someone and you don't get the asset in return. The work we and others are doing and thinking about how you can get that payment versus payment on chain with atomic settlement means that you don't necessarily need to go through a financial market infrastructure to address that same type of risk. Obviously, regulators may have a view, but from a pure tech perspective, you're going to start to see more and more institutions look for those solutions and get excited about the fact that settling on chain could reduce risk, could be quicker, and could be cheaper. When you get that holy trinity there, it's going to be really exciting. But ultimately, I think bilateral is where we'll start, and multilaterals, it's a lot more complex.
And just, of course, we at RULEMATCH might have something to say about that multilateral part, but I don't want to make too much of a pitch for RULEMATCH. But on the bilateral side, when you want to know your counterparties, right, and there is an element of trust, or at least a level of trust there, is that going to maybe localize things more in one sense, also with regulation playing a part as well? Will we see, if bilateral is the way to go, will it really stay as global in crypto markets, or will it become perhaps more regionalized?
Yeah, I think it depends on the adoption. And look, multilateral is always the most efficient, right? That's the way where you really get the most bang for the buck. I think there are complex ways to get there, but when it's sorted in a way that the market accepts, is consistently the most efficient. And that's what the largest players love to leverage when they understand it. When it comes to who you're trading with now, and that settlement piece, it doesn't have to be localized. I think the exception, as you point out, is going to be how governments deem to regulate it, what they incent and what they permit. So it doesn't necessitate better settlement turning into more localized trading as a result of that. I think it's going to come down to which parties are where they like to trade. And if there's a really good settlement solution, it's probably going to attract more attention than those that have that pre-funding model that's less efficient.
Mm-hmm. You alluded to it earlier that CLS came along kind of with a push from some bigger players. Central banks also, I believe, were kind of behind that. When you think about crypto, is it going to be bigger players, either big financial institutions or big tech players like Fireblocks, that are really going to push things forward towards a settlement that is more standardized, more efficient for the entire market?
So the approach we've been taking at Fireblocks is working with the leading players, right? Those that are market makers, the leading crypto exchanges, and work closely with them. And in large part, that's because you don't have the G5 jurisdictions or G10 jurisdictions dictating what it should be. Right? In the case with CLS, it was after a global FX or foreign exchange settlement issue that the largest central banks basically felt that they had no choice but to force an issue. I don't see that happening in crypto, notwithstanding the numerous examples of crypto-related issues in the past. So we're very much working with the private sector to help develop solutions. But Fireblocks also actively engages with regulators that are more open to the conversations. And there's many examples you could see in VARA and in Singapore and others where the market is not just the private sector, but very progressive regulators that have the appropriate concerns and want to protect their players, but are excited about the idea of helping drive the adoption of digital assets. So that's where it's best, where you have the private sector innovating, working closely with regulators, and not to influence the regulators, but educate them on the sort of solutions that are out there. That's the approach Fireblocks has taken. So I think we're going to continue to see that evolve in certain markets. And again, I pick on the UAE as one particularly progressive, where they're going to encourage the private sector to innovate in a way that aligns with what they think is appropriate from a risk perspective. And whenever you have that enlightened progressive government with respect to digital assets, is where the private sector gets the not so subtle nod of, okay, it's safe to play ball here, and let's do it in the appropriate way. Brazil is another great example where Banco Central do Brazil is actively experimenting with the technology and working closely with the largest Brazilian banks And there's numerous examples of them jumping into the space and trying to do it in a way that's appropriate for their stakeholders and clients.
Okay. I had the conversation with David Newens on the podcast from SDX just about this kind of top-down, bottom-up. I guess it takes both in some ways, regulation from top-down, but also market participants from the bottom up to find what the market needs and how it needs it. Maybe somebody like a BlackRock obviously is a big enough player to push things forward in some ways, and now they are into the crypto space and especially on the financialization side of things. Are there other things, just while we're on that topic, with settlement or around settlement from a technical standpoint, functionalities or features that you think institutions are going to look for, demand, in order to enable some of those things as the market goes forward?
Yeah, the two areas that I think about are going to be around versions of the off exchange that supports the collateral management, and then the DVP or PVP, the delivery or payment versus payment. Those are the things that are most important. And it's, again, not just a crypto story, but BlackRock's a great example, but institutions, whether it's BNP, SDX, PayPal, others that are bringing traditional financial assets, or RWA, as the term is, real world assets, on chain, they're looking for those sort of solutions. The unlock for why to tokenize something is because you can move those assets around and gain liquidity, but thinking about how you can securely transfer and settle that is the other half of that telephone ring that you need to have in order to really get the value proposition realized.
And where do you think we are in the time frame of moving towards not pre-funded trading activities with some kind of semi-standardization or acceptance in the broader market? Is it 5 years, 10 years, or
I was
closer?
going to use an American sports analogy. But I think we're very much in the second inning of a nine
Second
inning
inning.
baseball game, right?
Okay.
The first inning was all about pre-funding.
Yeah.
You could argue we're in the third inning. The second was looking for those solutions that really were just a transfer of credit risk that had certain benefits, but now we're starting to get to the technology solutions that mitigate it. And so we're still at that early adoption phase. Over the next 2 to 3 years, I think you'll see go from the early adoption of those tech solutions to much more material numbers. But when you think about what you need to get global adoption, the regulators is a key component, and the larger players coming into the space. We're starting to see that with some of the names we've been discussing on this conversation, but not yet in a meaningful way. When you think about the trillions of dollars that settle on FX every day, or the hundreds of billions of dollars in other assets, we're still early. But what's exciting is the rate of adoption is really, really high, and the growth rates that we're seeing quarter over quarter continue to climb. And that's an important signal for us all to be aware of.
Just a question that comes to mind right now, in crypto markets, we often talk about the FOMO that sets in. Do you think there's any kind of FOMO among large institutions? Not so much about the trading and the making money standpoint, but just about getting on board and getting on the train with a custody setup, with operations and so on. Is there an element of FOMO in that?
I think there is, right? Maybe you could argue that maybe it's a better version of FOMO than what we saw in the last bull run, or last time. It was very much, we just need to get to market. We need a buy, sell, hold strategy for our clients. What do we do? How quick can we do it? Now there's probably a much more thoughtful approach to it. But even in the US, I'll give the great example of BNY Mellon, who's been a consistent leader over the last 3-4 years in this space, getting the exception of SAB 121. And at that same time, you see articles about the job postings at State Street and how they're bringing the band back together for digital asset custody. So that's just one example. I think the FOMO is back, but it's now underpinned by really strong business cases around crypto, but also around the tokenization story.
So you mentioned the word, and that's exactly where I wanted to go now. Tokenization. It's there. It's out there. It's not very or super high on the adoption curve yet, but a lot of things happening. And Fireblocks is working in that space. You have kind of a launch pad, if I can call it like that, with different templates built in for launching a token. And just tell us a little bit about that, how it was built and what was the thinking behind that.
Sure. So from very early on in the vision of Fireblocks, it was very much about how you're going to be able to bring traditional assets on chain and move it around. Internet money, but done in much more sophisticated ways. But it doesn't stop with money, right? It very clearly goes on when you think about a fiat currency, and then it's a money market, and then it's different types of bonds, and from there, it's an easy leap into equity and other assets. And so, with that vision, the focus was how can we make it as simple as possible to take the traditional assets and bring them on chain. And we want it to be as simple as possible, but never giving up on any of the security standards or controls and risks that institutions like a BlackRock or a Franklin Templeton or others would care about. And so in the Fireblocks tokenization engine, what we've done is you have a variety of smart contracts. It's the tech that helps you tokenize or bring an asset on chain. And we've taken an approach of not only do we think we have some of the best and brightest smart contract developers and can have the ability to bring assets into a variety of different protocols, but it's a more open approach where we work with some of our partners, Tokeny, Bitbon, Securitize, and others that you can, if you've decided you want to use one of their smart contracts, you can do that through the Fireblocks tokenization engine, and then mint and burn, create or destroy those assets, all within the Fireblocks console. Really, really powerful. And as you get to more sophisticated financial instruments, we have the sort of developers that can work with you and figure out exactly what you need and guide on which is the right protocol for what you're trying to achieve, or protocols if you want to be on multiple protocols or different rails. And we're really starting to see a lot of adoption of that. You correctly point out we're still early on. If you compare tokenization and the value of tokenized assets versus traditional, many ways to go. But we've all seen the articles about the trillions of dollars that are expected to be tokenized by 2030. We're now in the billions of dollars is where we're counting. But many large institutions have put some meaningful projects out in the space, whether it's PayPal with just fiat-backed stablecoin, or BlackRock with BUIDL, Ondo, others. But so many of them are able to use the Fireblocks tech. And that's what gets us exciting about working on these different instruments and stablecoins and fiat-backed money and the bond issuances we're seeing in Europe. Those are the early signals of a lot more to come.
And is the target audience of that launchpad now more retail? Is this kind of a MVP getting started experiment in one sense to then potentially build something bigger?
No, so first of all, the product is not MVP. It's pretty robust, and we've been working with dozens of clients. The assets that are being tokenized, that's where it depends on what the focus is for our clients, right? So if you think about some of our clients are looking to issue stable coins that they want to engage with their clients. So if you think about Fireblocks in the B2B2C, our clients are in the B2C space. And so they want to issue tokenized fiat or a version of a money market to engage with their underlying clients. On the other hand, there's many examples where it's still in the B2B space. It's institutional investors that are looking to access these financial instruments on chain. And so the Fireblocks tokenization engine allows you to create and mint and burn those assets. And then it's not limited to the Fireblocks network, but we obviously have over 2,000 clients that are part of our network where you can transact through there, or you can move it to any wallet of your choice.
Okay, and there are some templates, as you said, built in. Those have different implications or different, shall we say, acceptance levels in different places. So I'm thinking jurisdiction-wise, regulatory-wise. How do you think about that? And will there be some more specification or more development on that to meet a really global market, since Fireblocks is a global company?
Yeah, there's definitely going to continue to be innovation in this space. And when we talk to clients, sometimes they come in with a very strong view of the type of characteristics that they want, what assets they want, what protocols they want. And it's a DIY. You can do that pretty quickly. But we also work with clients that have a strong thesis of what they want to do, but maybe have not considered all the different factors and characteristics of what you can do with the smart contract and when you tokenize. And that's when we'll work closely with them and educate them on the different options. We're careful that we're we're not outside counsel, we're not lawyers, we can't provide regulatory advice, but we can work with them based on their requirements. And because of the experience we've had with so many tokenization projects, we can also give perspective of what others in the market have done, which many of our clients come to us for, right? They want to know they're working with someone that's experienced and tokenized not just 100 coins, but have done dozens and dozens of tokenization projects with heavily regulated institutions at scale. And that's what gives them the confidence that when they're looking for that next new creative idea, whether it's a structured product or tokenizing horses, both of which we've done, we're going to be able to work closely with those clients on those use cases.
Okay, very, very interesting. I mean, the tokenization, the creation of the tokens is one thing. Now, I have to come at it again from a RULEMATCH perspective. What happens then with the tokens for trading and transfer? Is that also part of the full life cycle that comes out of that? Is that something that Fireblocks looks at also to facilitate?
So some of it, yes, but no different than the conversation earlier. We're not vertically integrated, right? We're not a transfer agent in the US. We're not going to provide global banking services. We're not providing prime brokerage services, right? So where Fireblocks does come in is not just with the wallet infrastructure. So if institutions want to invest in that tokenized asset, they can leverage the Fireblocks tech to do that. But depending on the jurisdiction, they may need transfer agents or not. There's partners we have that work with them. But when it comes to transfer, absolutely, right? Many of our clients that are on the Fireblocks network are excited about investing in other tokenized assets, and they can move the assets via the Fireblocks network in a way that's safe, secure, and efficient. And so we're excited to partner with our clients that are tokenizing these assets, but also respect there's a role for financial service providers, of which, broadly speaking, Fireblocks is not. So there's that partnering angle, but we're not able to do everything, nor should we. But making sure that we're bringing that tech to help underpin that where appropriate is really where we focus.
And yeah, just as you say, that's not your focus, but of course, in some places, many places, there are rules in place about issuers and custodians and different things like that. So I suppose people who come to do this tokenization have questions about that, or they have some considerations with that.
Yeah, that's right. And so we have a team of business solution advisors that can help explain what we've seen in the market. We also have a global custody network. So these are licensed custodians in a variety of jurisdictions that have made the smart choice of using our technology and part of the Fireblocks network. And where appropriate, we're very happy to bring them in and make sure that if the client needs a custodian in the UAE or in London or in Sydney, Australia, we're introducing them to those licensed custodians that can help provide that financial service for them.
Is that also one angle for the Fireblocks Trust Company that you also work with?
Yeah, so the Fireblocks Trust Company is a brand new entity at Fireblocks, wholly owned subsidiary. It's a licensed qualified custodian regulated by the NYDFS, the New York Department of Financial Services. So we're recently launched, and so we're in our MVP stage. But as we continue to build the Fireblocks Trust, for those institutions that need a qualified custodian to support their tokenized assets, there's absolutely an avenue for us to play that role.
And just more broadly, looking at where we are in tokenization with everything going on, who would you put your money on right now in the tokenization space? Who is really ahead, leading the pack?
So look, early movers, BlackRock has made a lot of noise in the market and really brought something to market at scale. When you think about the banks, BNY Mellon has really put a lot of thought into that, and knowing what BNY Mellon provides to the industry today in traditional finance, there's a lot that they're going to be able to offer their clients with the efficiencies of blockchain and digital assets. So in the US, I think about them. I think BNP and ABN AMRO in Europe are also starting to set the pace, and we're really excited about that. And there's just a lot of opportunity for these traditional players, for Fireblocks, and even the blockchain protocols that are providing that underlying tech to come together and continue to build on their leads.
Very, very interesting. We come now to the part where I ask you to look into your crystal ball, kind of our last question that we ask all of the guests on RULEMATCH. Spot on. Is there something going on either at Fireblocks or out in the market in general that not too many people have heard about or know about yet, but something we should keep our eye on in the next 3, 6, 9 months?
Yeah, so Ian, I'm going to ask you to keep me honest in 3 to 9 months. I was asked a similar question a year ago, and I said that there needs to be better solutions about interoperability between protocols, and we're starting to see that. So we'll see how I do this time. Things that I think are going to be exciting is around the collateral management space, for reasons similar to what we discussed around why pre-funding is not great. Finding a combination of interest-bearing assets and concepts of off-exchange that may or may not leverage custodians, those solutions are going to be really important. So that's more efficient use of collateral. This may sound boring, but for the institutional traders, they know how important this is and how efficient or inefficient the market could be. I think you're going to start to see some really good solutions that think about different type of tech in this space that allow for much more advanced collateral management without giving up on the level of credit exposure that you have with your trading parties.
Very, very interesting. I would look forward to see that, and I think from a RULEMATCH perspective also, that's something we would be interested to see. With that, we'll wrap things up. Adam Levine, thank you very much for joining RULEMATCH Spot On. It's a very great conversation. Look forward perhaps to talking to you again in the future.
Sounds great, Ian. Thanks a lot, and really appreciate the opportunity.